Listen closely because the next few minutes could completely change the way you see money, time, and your future. While most people are scrolling, sleeping, or stressing, the smartest investors in the world are quietly positioning themselves for one of the biggest wealth transfers of this decade. We are standing at a precipice where the old rules of finance are not just bending, they are snapping. For decades, you were told that a steady paycheck and a savings account were the pillars of security. But today, the shadow of a $7,000 silver price target is no longer a fringe theory. It is a mathematical warning. The world is currently drowning in over $300 trillion of global debt. This is not just a number on a screen. It is a ticking clock. When Robert Kiyosaki warns that the dollar is losing power and real assets are becoming priceless, he is not trying to cause panic. He is providing a map for the storm. History is simple and brutal. Those who protect their purchasing power during periods of extreme uncertainty do not just survive, they rise. They become the new architects of the financial landscape, while the unprepared watch their life savings evaporate into the atmosphere of inflation. Success in this new era is not about working harder. It is about seeing earlier, acting sooner, and thinking differently from the masses who are still waiting for permission to be wealthy. The word on the table right now is silver. To the uneducated, it is just a commodity. To the strategist, it is a compressed spring of value, a monetary insurance policy, and a bridge to a future where paper promises are revealed as illusions. This is the moment where wealth migrates from those who trust the system to those who trust the laws of economics. We are witnessing a quiet declaration of self-reliance by the most sophisticated minds in finance. They are moving away from digital digits and returning to tangible reality. If you have ever felt that tight pressure in your chest, that feeling that your life is being decided by forces you do not understand yet, then this message is your wake-up call. The gap between the informed and the distracted is widening every single day. One group will look back at this year and see it as the foundation of their empire. The other will look back and say they wish they had listened when the signs were clear. The question is never will change come. The change is already here, moving beneath the surface of the headlines. The only question that matters is whether you will be positioned correctly when the full weight of this transition hits the global markets. Are you holding paper that can be printed into oblivion? Or are you holding the very substance that has outlasted every empire, every war, and every failed currency experiment in human history? This is the beginning of the end for financial complacency. Let us examine the data, the history, and the strategy that will define the winners of the next 10 years. To understand why silver could reach $7,000, we must first understand the fragile foundation of the world we live in today. For over 50 years, the global economy has operated on a grand experiment known as fiat money. Since 1971, when the link between the United States dollar and gold was severed, money has been backed by nothing more than a promise from a government. It is a system built on faith, not on value. When you look at the currency in your wallet, you are not looking at an asset. You are looking at a debt instrument. The problem with a system based on paper promises is that there is no limit to how many promises can be made. In the last few years alone, central banks have created trillions of dollars out of thin air. This is a process they call quantitative easing, but in plain language, it is the dilution of your hard work. Every time a new dollar is printed, the value of the dollars you already own decreases. It is a silent theft that happens while you sleep. Most people feel this as the rising cost of living, but what is actually happening is the falling value of the currency. We are currently witnessing the end stage of this experiment. Total global debt has surged to record levels, surpassing $315 trillion in 2024. To put that in perspective, that is over 300% of the entire world gross domestic product. Governments are now trapped in a cycle where they must borrow more money just to pay the interest on the money they already borrowed. This is the definition of a debt trap. When a system reaches this point, there are only two ways out: a massive default or the total devaluation of the currency through hyperinflation. The smartest investors, like Robert Kiyosaki, recognize that the system is losing its ability to stabilize itself. For decades, the public was taught that cash in the bank was the ultimate security, but in a world of negative real interest rates and massive debt, cash is a liability. It is a melting ice cube. If the currency loses 5 to 10% of its purchasing power every year, you are losing a decade of your working life every few years without even realizing it. The illusion of safety is the greatest risk of all. This is why the migration into real assets is accelerating. When people lose trust in the paper, they return to the tangible. They return to things that cannot be created with a click of a button or a political decree. This transition has happened hundreds of times throughout human history. From ancient Rome to revolutionary France to modern-day emerging markets, the pattern is always the same. Paper money eventually returns to its intrinsic value, which is zero. Meanwhile, assets like silver and gold do not just hold value. They become the only remaining bridges to the next economic era. The definition of safety is being rewritten in front of our eyes. In the old world, the system took care of those who followed the rules. In the new world, the system is forced to sacrifice the savers to save itself. Understanding this shift is the first step toward true financial independence. You must stop thinking in terms of how many dollars you have and start thinking in terms of how much purchasing power you control. Once you see the fiat illusion for what it is, you can never go back to being a passive observer. You become a strategist in a world of players. While gold often captures the headlines as the ultimate safe haven, silver is the hidden giant of the financial world. It is a unique asset that lives in two universes simultaneously. It is a precious metal with a 5,000-year history as money, and it is an indispensable industrial commodity that drives the modern world. This dual nature is exactly what makes silver a compressed spring of value, ready to explode as global conditions tighten. To understand the $7,000 alert, one must look at the widening gap between supply and demand. The industrial demand for silver is not just growing, it is accelerating. We are currently in the midst of a global energy transition. Silver is the most conductive element on Earth, making it essential for the production of solar panels, electric vehicles, and 5G telecommunications infrastructure. A single electric vehicle can use up to twice as much silver as an internal combustion engine car. As the world pushes toward green energy mandates, the demand from the photovoltaic industry alone is projected to consume a massive percentage of total annual silver production. This is not speculative demand, it is structural necessity. On the other side of the equation, the supply of silver is under immense pressure. Unlike gold, which is mostly stored in vaults and recycled, a vast amount of silver is consumed in industrial processes and often ends up in landfills because it is not yet cost-effective to recover in small quantities. Furthermore, silver is primarily produced as a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver skyrockets, miners cannot simply flip a switch to produce more. It takes years, sometimes a decade, to bring a new mine into production. We are looking at a decade-long supply deficit that shows no signs of closing. This physical scarcity is further magnified by the monetary demand. As inflation erodes the value of the dollar, millions of small investors and massive institutions are beginning to look for an entry point into the silver market. Because the silver market is significantly smaller and less liquid than the gold market, even a small shift in investment capital can lead to a violent move in price. When the masses realize that the paper silver market, where trillions of dollars in digital silver are traded, is not backed by enough physical metal to satisfy delivery, we will witness a short squeeze of historic proportions. Robert Kiyosaki often calls silver the biggest bargain in the investment world. For much of history, the ratio between the price of gold and silver was approximately 15-1, meaning it took 15 ounces of silver to buy 1 ounce of gold. In the modern era, that ratio has fluctuated wildly, often reaching levels of 80-1 or even 100-1. This disconnect suggests that silver is severely undervalued relative to its yellow counterpart. If the ratio were to return to its historical mean while gold continues to rise, the price appreciation for silver would be astronomical. Silver is a story of patience and physics. You cannot print silver. You cannot manifest it out of a central bank computer. It must be pulled from the earth at a great cost of energy and time. In a world of infinite paper and digital illusions, silver represents the hard reality of math and chemistry. It is the ultimate insurance policy for the common man because it is still accessible, yet it possesses the explosive potential of a high-growth technology stock. Every ounce you hold is a claim on a finite resource that the world desperately needs to function. To predict where we are going, we must look at where we have been. History is not a straight line, but a series of cycles. For those who study the history of economics, the current state of the global financial system is hauntingly familiar. Every great empire that has ever collapsed followed the exact same path. Expansion, overextension, debt, and finally, the debasement of the currency. From the Roman Empire to the Weimar Republic, the story never changes. Only the names of the currencies and the faces on the coins are different. In ancient Rome, the currency was the denarius. At its peak, it was 95% pure silver. But as the empire expanded and the costs of war and bureaucracy grew, the emperors began a process called clipping the coins. They reduced the silver content, replacing it with cheaper metals like copper. By the year 268, the denarius contained only about 0.5% silver. The result was a catastrophic loss of purchasing power. Prices skyrocketed, trade collapsed, and the middle class was wiped out. Those who survived were the ones who had hoarded the original, high-purity silver coins. They held the only real wealth in a world of worthless metal. Fast forward to the 20th century, and we see the same pattern in the Weimar Republic of Germany. After World War I, the government printed astronomical amounts of marks to pay for reparations and social programs. In 1919, 1 ounce of gold cost about 170 marks. By late 1923, that same ounce cost 87 trillion marks. People were using wheelbarrows full of cash to buy a single loaf of bread. Savings that had taken a lifetime to accumulate were rendered useless in a matter of months. But even in that chaos, silver and gold remained the ultimate stabilizers. An ounce of silver could buy more food during the height of the crisis than it could during times of peace. These are not just stories from dusty textbooks. They are case studies in human behavior and monetary physics. Whenever a society reaches a point where it can no longer pay its debts, it always chooses to print money rather than admit bankruptcy. Printing is easier, quieter, and it delays the inevitable. But it comes with a price: the destruction of the currency. Today, we are seeing the same signals in the United States and across Europe. The total debt to GDP ratio is at levels historically associated with currency resets. History teaches us that during these resets, wealth does not simply vanish, it is transferred. It migrates from paper liabilities back to hard assets. In the 1970s, the world experienced a massive stagflationary shock. The dollar lost over half of its value in a decade. During that same period, silver went from less than $2 an ounce to nearly $50. That was a 25-fold increase in value. It was not because silver became more useful, but because the dollar became less trustworthy. The lesson for the modern investor is clear. You do not need to be a prophet to see what is coming. You only need to be a student of the past. The people who protected themselves in Rome, in Germany, and in the 1970s were not the loudest or the most famous. They were the ones who recognized that when the system begins to lie, the truth is found in tangible reality. By holding silver today, you are aligning yourself with the same defensive strategy that has preserved wealth for over 2,000 years. You are opting out of a failing experiment and into a proven legacy of value. The headline figure of $7,000 for an ounce of silver sounds like a fantasy to the average person on the street. To the man who checks the daily spot price on his phone, it seems impossible. But when we look through the lens of a global currency reset, that number becomes a logical outcome of a mathematical reality. We must understand that a $7,000 silver price is not necessarily a reflection of silver becoming more valuable, but rather a reflection of the dollar becoming nearly worthless. In a hyperinflationary scenario, prices do not just move by percentages, they move by orders of magnitude. If the world loses faith in the United States dollar as the global reserve currency, the flood of trillions of dollars currently held in foreign reserves will come rushing back to American shores. This would create a tsunami of liquidity, chasing a finite amount of goods and services. In such an environment, the price of everything, from bread to gasoline to silver, would revalue in a terrifyingly short window of time. Robert Kiyosaki and other macroeconomists point to the historical gold-to-silver ratio as a key indicator. If gold were to reach $15,000 or $20,000 in a crisis, which many analysts believe is possible given the current debt levels, a return to the historical silver ratio of 15 to 1 would put silver well over $1,000. However, if we factor in the extreme industrial scarcity and the collapse of the paper derivative markets, the price could overshoot all historical norms. The $7,000 alert is a signal to prepare for a world where the nominal price of an asset no longer matters, only the purchasing power it represents. To understand how this works, look at the shadow gold price. This is a calculation that takes the total United States M1 or M2 money supply and divides it by the amount of gold held by the Treasury. If we were to return to a gold-backed system today, the price of gold would have to be set at tens of thousands of dollars just to cover the existing debt. Because silver is more scarce than gold in terms of available investment-grade bullion, the price reaction in silver would be even more violent. We are talking about a total revaluation of reality. This alert is also driven by the death of the paper silver market. For every 1 ounce of physical silver in a vault, there are hundreds of ounces of paper silver traded on digital exchanges. This is a massive leverage bet that works as long as nobody asks for their metal. But in a crisis, everyone will ask for their metal at the same time. This is known as a delivery failure. When the exchanges run dry, the price of silver will no longer be determined by a computer screen in London or New York. It will be determined by the man who holds the physical bar in his hand. The $7,000 target is a warning that the exit door is very small and the crowd is very large. When the shift happens, it will not be a slow climb. It will be a vertical move that leaves the majority of investors behind. By the time the news reaches the mainstream media, the opportunity to buy at reasonable prices will be long gone. Positioning yourself now is not about greed. It is about recognizing the scale of the imbalance in the system and ensuring that you are on the right side of the most significant price correction in human history. Building wealth is not a matter of luck or simply having the right information. It is, at its core, a psychological game. The reason most people fail to capitalize on opportunities like the silver market is not a lack of intelligence. It is because they are wired for consensus and comfort. To survive and thrive during a global wealth transfer, you must first master the inner landscape of your own mind. The majority of the population waits for the crowd to move before they feel safe enough to act. But in the world of finance, consensus is the enemy of profit. The wealthy mindset operates on the principle of conviction over consensus. When Robert Kiyosaki talks about the dollar becoming trash, the average person laughs or dismisses it as extreme. They do this because their brain is programmed to believe that the current reality will continue forever. This is known as normalcy bias. It is a psychological defense mechanism that prevents people from seeing an impending crisis. The professional investor, however, trains himself to look at the data objectively. He understands that the most significant gains are made when you are willing to be lonely and misunderstood for a period of time. Fear is the primary tool used by the system to keep people in line. When the markets are volatile, fear causes the masses to sell their assets at the bottom and buy back at the peak. They are reacting to short-term emotions rather than long-term structures. To win, you must develop a different relationship with discomfort. You must recognize that the feeling of uncertainty is often the signal that you are entering a zone of high potential. Every major fortune in history was built by someone who moved while the world was still confused. They did not wait for the headlines to confirm their decisions. They made their decisions and let the headlines catch up. Another key psychological barrier is the difference between price and value. The amateur focuses on the daily price of silver. If it drops $1, he panics. The professional focuses on the value. He asks, has the debt decreased? Has the printing stopped? Is the industrial demand still there? If the value remains high, but the price drops, the professional sees a sale, not a crisis. This shift in perspective allows you to remain calm while others are losing their heads. You stop being a victim of the market and start being a predator of opportunity. Furthermore, the psychology of wealth requires a transition from being a consumer to being a preserver. Most people are trained to work for an income and then immediately exchange that income for depreciating liabilities. They are on a treadmill that never ends. The wealthy individual works to acquire assets that will work for them. They understand that every ounce of silver is not just a metal, it is a soldier in their private financial army. It is a brick in a wall that protects their family from the storms of the state. Finally, you must take total responsibility for your financial education. The system does not want you to understand how money works because an informed population is harder to control. They want you to remain a student of the old world. To transition into the new world, you must become a student of the future. This means reading, studying cycles, and surrounding yourself with thinkers who expand your vision rather than limit it. The moment you decide that you are the captain of your own financial ship is the moment your trajectory begins to shift. Wealth is not given. It is taken through clarity, discipline, and the courage to think for yourself. Inflation is often discussed in the media as a mere economic statistic, a percentage point on a government report. But for the man who is trying to build a future for his family, inflation is something far more sinister. It is a silent tax. It is a redistribution of wealth that requires no legislation, no vote, and no public debate. It is the process by which the purchasing power of your labor is siphoned away to pay for the mismanagement of the state. Understanding how this tax works is essential to understanding why tangible assets like silver are the only effective shield. Most people only notice inflation when the price of a gallon of milk or a liter of fuel goes up. They see the effect, but they do not understand the cause. The cause is not greedy corporations or supply chain disruptions, though those can play a part. The primary cause is the expansion of the money supply. When the government prints more currency to cover its deficits, it is essentially diluting the value of every dollar already in existence. If you have $10,000 in a savings account and the money supply doubles, your $10,000 now represents half as much of the total economy as it did before. You still have the same number of dollars, but you have lost half of your wealth. This is particularly devastating for the middle class and those on fixed incomes. While the wealthy own assets like real estate, stocks, and precious metals that rise in nominal value during inflationary periods, the average worker is stuck with a paycheck that rarely keeps pace with the cost of living. This creates a hidden transfer of wealth from the poor and the middle class to the government and the banking sector. It is a system that rewards debt and punishes thrift. In an inflationary world, the saver is the loser. The person who followed the traditional advice to work hard and save money is the one who suffers the most. To beat the silent tax, you must change the structure of your financial life. You cannot win a game where the rules are designed to make you lose. This is why Robert Kiyosaki emphasizes the importance of moving from paper assets to real assets. Silver is the perfect antidote to the silent tax because it cannot be diluted. There is no central bank for silver. There is no printing press that can create more of it out of thin air. When inflation rises, silver does not just hold its value, it often overcompensates as people rush to find safety. Consider the psychological toll of the silent tax. When people see their hard-earned savings losing value, it creates a sense of desperation and powerlessness. It forces people to take more risk just to stay in the same place. They begin to gamble on speculative stocks or cryptocurrencies, hoping for a quick win to offset their losses. This is exactly what the system wants, because it keeps the population in a state of constant anxiety and dependence. By holding physical silver, you opt out of this cycle. You create a baseline of stability that allows you to think clearly and plan for the long term. The silent tax is also a global phenomenon. We are currently seeing a coordinated effort by central banks around the world to inflate away the massive debt piles accumulated during the last 2 decades. We are entering a period of financial repression where interest rates are kept below the rate of inflation. This means that anyone holding cash or government bonds is guaranteed to lose purchasing power every year. In this environment, silver is not just a commodity, it is a tool of resistance. It is the only way to ensure that the work you do today will still be able to provide for you and your family 20 years from now. In the world of high-stakes finance, fear is not just an emotion. It is a commodity. It is bought, sold, and traded by those who understand how to manipulate the masses. When the headlines scream about a looming recession, a banking collapse, or a currency crisis, they are selling fear. This fear serves 2 purposes. First, it keeps the majority in a state of paralysis, preventing them from making the bold moves necessary to protect their future. Second, it creates opportunities for the elite to acquire valuable assets at a massive discount from those who are panicking. Every major investor you admire has had to face the same crossroads you are facing today. The difference is that they have trained themselves to view fear as a contrarian indicator. When the crowd is terrified, the professional is curious. When the crowd is complacent, the professional is cautious. Fear is expensive because it forces you to make decisions based on the immediate present rather than the distant future. It closes your eyes to the long-term cycles of history and focuses your attention on the noise of the hour. If you allow fear to dictate your financial strategy, you are essentially paying a tax to those who are brave enough to take the opposite side of your trade. The $7,000 silver alert is designed to cut through this manufactured fear. It is a call to move from a state of caution to a state of confidence. This confidence does not come from blind optimism, but from deep study and preparation. When you understand the fundamental supply and demand mechanics of silver, and when you recognize the inevitable trajectory of a debt-based monetary system, the fear disappears. It is replaced by a sense of urgency. You realize that the discomfort you feel when making an investment is actually the doorway to a new version of yourself, a version that operates from a position of strength rather than reaction. In the current environment, many people are afraid to buy silver because they are worried the price might drop tomorrow. They are afraid of being wrong in the short term, but the real danger is not a temporary dip in price. The real danger is being left behind when the system finally resets. The cost of being wrong about silver for a few months is negligible. The cost of being right about the dollar collapse but being too afraid to act is catastrophic. This is the asymmetry of the current moment. The downside of holding real assets is limited, while the upside is practically infinite. To master fear as a commodity, you must audit your financial life and eliminate the vulnerabilities that feed your anxiety. This means getting rid of bad debt, strengthening your cash flow, and building a foundation of tangible assets. When you own your home, your tools, and your precious metals outright, you are much harder to scare. You are no longer entirely dependent on the digital grid or the promises of a banker. This physical and financial independence translates into psychological power. You can watch the headlines with a sense of detached observation, knowing that you have already built your lifeboat before the storm hit. Fear will always be present in the markets because the stakes are high. But you have a choice. You can let fear consume your potential, or you can use it as fuel for your preparation. The people who will lead the next decade are those who are acting now. While the signals are clear, but the crowd is still arguing, they are buying the assets that the fearful are selling, and they are doing so with the quiet knowledge that history always rewards the decisive. Don't be the person who looks back and says they were too afraid to listen. Be the person who saw the fear in the world and used it as a signal to secure their legacy. Understanding the value of silver is only the first step. The second, and more critical step, is knowing how to integrate it into a broader financial architecture. Strategic allocation is the art of positioning your resources so that you are protected against the worst-case scenarios while remaining open to the best-case opportunities. For the modern investor, This is not about gambling or speculation. It is about building a resilient ecosystem that can withstand currency debasement, market volatility, and systemic shocks. A professional allocation strategy begins with the concept of the core versus the satellite. Your core holdings should consist of assets that have no counterparty risk. This means physical silver and gold held in your direct possession or in ultra-secure, non-bank storage. In a world of digital digits, if you do not hold it, you do not own it. Robert Kiyosaki often suggests that for those just beginning to build their ark, a significant portion of their liquid net worth should be moved into these hard assets. This is your insurance fund. It is not there to be traded for a quick profit. It is there to ensure your survival and purchasing power. Once your core is established, you can look at satellite positions. This might include silver mining stocks or streaming companies. These assets offer leverage. If the price of silver moves up by 10%, a well-managed mining company might see its stock price increase by 30 or 40%. However, these come with counterparty risk, such as management decisions or jurisdictional instability. Therefore, they should never replace your physical holdings. They are the engine for growth, while the physical metal is the hull of your ship. The timing of your allocation is just as important as the assets themselves. Many people try to time the market, waiting for the perfect bottom. This is a trap. The smarter approach is dollar cost averaging. By committing to buy a set amount of silver every month, regardless of the price, you remove emotion from the equation. You buy more ounces when the price is low and fewer when the price is high. Over time, this discipline builds a massive position that is insulated from short-term market noise. Consistency is the secret weapon of the wealthy. Furthermore, strategic allocation involves looking at your entire balance sheet. You must eliminate high-interest consumer debt, which is a form of negative compounding that works against you. You should also consider the geography of your assets. In a global crisis, having all your wealth in one jurisdiction or one currency is a risk. Diversifying into physical assets across different regions can provide a level of security that a single bank account never could. You are building a fortress, and a fortress needs multiple layers of defense. Finally, remember that the most important asset in your allocation is your own human capital. Your ability to earn, to solve problems, and to navigate complex environments is what allows you to acquire more silver and gold. Use a portion of your resources to invest in your education and your network. Surround yourself with people who understand the macro environment and who are also positioning themselves for the future. Strategic allocation is a lifelong process of adjustment and refinement. By starting now and following a disciplined plan, you move from the category of the victim to the category of the victor. We have covered the history of failed currencies, the undeniable math of global debt, and the unique physical properties that make silver the ultimate asset for this decade. But now, we come to the most important part of this journey, the decision to act. Information without execution is merely a distraction. You can watch every video, read every report, and study every chart, but if you do not move your resources from the world of paper to the world of reality, you will remain vulnerable to the forces of inflation and systemic decay. The $7,000 silver alert is a call to awaken your dormant potential. We are living through a period of time that will be written about in history books for centuries. Our grandchildren will ask us what we did when the old monetary system began to fracture and the signs of a global wealth transfer became visible to everyone. Those who took action will have stories of resilience and foresight. Those who waited for the crowd will have stories of regret. This is your moment to choose which side of history you want to inhabit. Success in the coming era is not reserved for the lucky or the born wealthy. It is reserved for the disciplined and the brave. Every ounce of silver you acquire is a vote for your own independence. It is a statement that you are no longer willing to let your future be decided by central bankers and politicians who do not have your best interests at heart. It is the beginning of a life defined by ownership, control, and clarity. By securing your purchasing power now, you are buying more than just metal. You are buying the freedom to make choices when others are forced to make compromises. Start small if you must, but start today. Audit your finances, educate your mind, and begin the process of building your physical foundation. Do not wait for the perfect moment, because the perfect moment is always the one where you finally take control. The world is changing, and the old rules are gone. But for those who are prepared, the future is not something to be feared. It is an opportunity to be seized. You have the map, you have the data, and you have the strategy. Now, you must have the conviction to follow through. Thank you for joining me on this deep dive into the global financial landscape. If this message has sharpened your focus or given you a new perspective on your wealth, I encourage you to stay committed to your path of education and action. Subscribe to this channel for more strategic insights on wealth, resilience, and the future of the global economy. Share this knowledge with those you care about, because a prepared community is a strong community. The journey to $7,000 silver is just beginning, and the winners are those who are already on the move.